My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you think that's interesting, please consider liking this video and subscribing to the channel. Today, we have a viewer submission that we're taking a look at. Shout out to JM Action here, who commented on my video about Duke Ranch. If you haven't watched the video about Duke Ranch, be sure to check that out. That's a new series where I dive into the ranch that my family and I purchased, and our adventures turning that into a legacy asset. But anyways, JM Action commented here, what do you think about EIX being in York, California? He also shouted out a different one, but today we're going to discuss EIX. So thank you to JM Action. Hopefully I'm saying that right. You commented on a lot of my stuff. Really appreciate your input. Today we're going to be talking about EIX, ticker otherwise known as Edison International. As usual, I'm going to give a brief overview of the company, talk about some of the factors that are driving the current price action. We're going to take a look at the financials and discuss some of the risk factors, and ultimately I'm going to give it a grade: buy, sell, or hold. So stick around for that. So let's just dive into it. Edison International is a utility company that primarily serves Southern California. In fact, it says here, Edison International, through its subsidiaries, engages in the generation and distribution of electric power. The company supplies and delivers through its electrical infrastructure to an approximately 50,000 square mile area of Southern California. It serves residential, commercial, industrial, public authorities, agricultural, and other sectors. We don't have a total here, like the amount of kilowatts it has, but it's been around for a long time. Founded in 1886 and based in Rosemead. So if you're in California or familiar with it, this is basically one of the two utility companies, the other being PG&E. We don't have Edison International here in my area. I'm up in the Bay Area, but it is one of the SoCal utility companies. So I'm aware of the company, and I've never really dived deep into looking at it myself. However, you see what happened here. Of course, what happened here is the Pacific Palisades fire, the LA fire that caused a lot of damage. And Edison has effectively been implicated in that and faces potential fines and penalties. In fact, we see here September 4th, the Department of Justice sues Southern California Edison. The price plunged on the news of the fire and has not recovered. I will just make a brief comment that around the time of that, a lot of their bond issues, a lot of their bonds also sold off very hard on the news, but have since recovered. So just an observation here, we see the stock prices plunged, however, has not recovered. Interesting. That gives us some clues to dig in. Of course, given that debt is of more senior priority in the capital stack than equity in terms of the priority of payments, the fact that the debt has recovered and the equity has not might give us a clue as to what the financials might look like. So I will say that when I saw the debt plunge, I was looking at corporate bond issues to purchase. Their debt flagged my radar, and I considered purchasing a few of their bonds, but I just didn't get comfortable enough with it, and it would have been a phenomenal investment. Like I said, the bonds have recovered. They plunged 20 to 30% on the news and have since recovered. So very, very strong equity-like returns on the bonds. That ship has come and gone. Most of the bonds are trading above par right now. So that's what's driving the price action, is all of this litigation risk with the fire. So I feel like in order to analyze this company, I think we just need to do our best here to really assess the exposure that the company has, and go from there. For those that remember, a couple of years ago, what is the PGA ticker? PCG. For those that remember, a few years back, PG&E was implicated in a fire. I forget what the fire was called. This is prior to my time living in California. PG&E was implicated in a fire, and they were found liable for whatever. I'm not super familiar with this, but basically, a wildfire happened. They had a ton of exposure, and they were penalized for it. And the way that they did that was they diluted the crap out of their shares. And you see here, their stock price really hasn't recovered from that. It's doubled since then, I guess. So I guess that counts. But nowhere near where it was prior. Okay. So let's go back to Edison. So before I get too into the weeds about my thoughts here, let's just take a look at, I'd really love to be able to see. I've never looked at any of this stuff before, by the way. Again, their bonds look interesting. I just never looked deep into the company. There were other things that looked better for me to dive into, and I did. So I've never really taken a look at this stuff. What I'm hoping to find, and I might not find it here, what I'm hoping to find is like some sort of map. If I can see like some sort of, I'm pulling this from databasin.org. This is the service area of the utility. So it does not appear to fully cover certain areas of LA, but pretty modest portion of Los Angeles County, Orange County. Looks like they cover almost all of San Bernardino County, Ventura County, all the way up to Santa Barbara, and then up into the desert there. That never loaded for us. So does a company like this have a moat? Yes, of course they do. Maybe there's some overlap there with PG&E in a few of the areas. But as with any utility, particularly the utility companies in California, very, very strong regulatory moat there. So I don't think you got anything to worry about there from that perspective. Company has performed fairly strongly over time, but not as of late, particularly in light of what's happening. Let's just do our best to take a look at some of their provided numbers. They have this wildfire mitigation plan. 2026 to 2028 wildfire mitigation plan is a layered defense strategy to safeguard our communities. Anticipated $6.2 billion investment. What is their market cap? $21 billion market cap. That's pretty bad. You see total debt here, $40 billion. 140 million of cash. So yeah, they've got a larger debt than market cap, pulling off that enterprise value. So yeah, pretty, again, not uncommon for a utility company. And PG&E's method of funding their large liability was from diluting shareholders. And I think that the market is anticipating the likelihood of that happening. You see that borne out in the fact that their stock price has not recovered from this 80s level down into the 50s. If we look at PG&E chart, see here it was at all-time highs, and it had a similar 30% ish drawdown from 80 to 50. Pretty severe drawdown from here to here, and then it took from 2017, from August 2017. January 2019. Took about a year and a half for things to get to where they were, but you saw here there was a second leg down that plunged the price So it was more than a 90% drawdown. Let's just verify that this was what I'm saying is true. The shareholders were left holding the bag on that one. So I think that's what we're looking at here. It's again, companies like this, they, due to their market position, due to their importance, due to all that, they are very much able to raise the necessary capital to be able to, uh, you know, perform their required outlays when they are held liable for these things. But it certainly was pretty ugly for PG&E shareholders, and the market does appear to be respecting that might be a possibility for Edison. Another thing to think about here, GRC, in the absence of 2020. Look at this. Again, there's a lot of acronyms here. Not really sure what that means, but it doesn't really matter because, again, look at this: 38 to 43 billion dollars of CapEx over that time frame. Capital deployment expected to increase in 2025 to 2028. Capital expenditures over $7 billion a year versus these numbers. Projected 6 to 8% rate-based growth. Substantial additional investment opportunities offer upside. Strong rate-based growth driven by wildfire mitigation and important grid work to support California's leading role in clean energy transition. In other words, we might be held liable for a fire. We're raising rates. Important grid work. Rates are going up. EIX expects 5 to 7% core earnings per share growth for 2025 to 2028, with financing plan showing minimal equity need, $400 million of equity. So they are saying that they will need to dilute shareholders, but they're saying, you know what, it's not going to be nearly as bad as what happened to PG&E. Central, $6 to $7 billion of dividends, 27 to $32 billion of capital. They're saying they're going to take on another $8 to $11 billion of debt, but net cash provided by operating activities 25 to 28 billion. So I think it is worth appreciating the strong cash generative nature of this business, given their market share, market position, and the nature of their business. Essentially, is the importance of their business to the market. So what they're saying, again, what management is saying is we're going to grow in this, this is a really good earnings per share growth, by the way, for utility. Notice how it's not going to grow as fast as base growth, rate-based growth. That's the opposite of operating leverage. That's operating leverage working in reverse. So they're basically saying whether that's driven by dilution of shareholders by issuing shares, or whether it's driven by additional investment, although CapEx wouldn't come out of earnings per share, I wouldn't think. But either way, for those who are reading between the lines there, typically you want to see this number growing faster than this number, right? Because that's operating leverage. So I'm not necessarily concerned by what I'm looking at, given what I know about the risk. But I think we need to look at this plan, and we need to not take it with a grain of salt. Again, and there's a lot of things that have yet to settle, have yet to come out. Key messages: Eaton fire investigations ongoing. Southern California Edison plans to launch wildfire recovery compensation program. Confident that legislative action will ultimately enhance the regulatory framework. Continued strong regulatory progress. WMCE settlement approved. Final decision issued in WMBM proceeding. GRC proposed decision issued. I'm just going to look this up. I'm tired of not understanding what GRC means. And if it's obvious, the general rate case application. Okay, so that's just their ability to increase rates. WMC. We'll look up that too while we're on the task. Okay, so that's wildfire related. They've got their settlement approved. This is for a different event, obviously. Okay, so I'm not going to spend too much time on those. I would urge my viewers who are interested in this stock or those who own it already. I don't, by the way. No holdings. I would urge a very lengthy dive into these things. I know that that's partly what you're wanting me to do. I'm kind of skimming through here to give my thoughts, but there's a lot of hair on this one. So where I'm at now is basically that. Basically, we're not out of the woods yet. It appears we're not out of the woods yet, and the reason. What day is this? July 31st. So this is almost 3 months ago. We'll see what their comments are here in a few weeks on their new earnings. The timing of this video might even be a bit unfortunate in that regard, but given the new lawsuit that's come to light. But yeah, basically, we got a huge cliff of finances that are coming down. Ultimately, I would say if you're in this is why the debt recovered, right? If you're in the debt, you're fine collecting. Their bonds are yield, their coupons are between 5 and 8% on a lot of these bond issues that they have. So I think bondholders can feel pretty confident that they're going to continue to get paid. And that's really reflective of the fact that they're going to continue to issue more debt. And they have strong underlying cash flow. However, what they talk about here is 21 straight years of dividend growth, 6% current dividend yield, target dividend payout. Yeah, I would, if you're hoping to get a deal on this stock, it certainly is a deal right now. I mean, it's less than 10 times forward earnings, close to 6% dividend. But I wouldn't be too shocked if they run into trouble, right? And you look at their revenues, their revenues have grown quite a bit in recent years, almost 50% in 5 years. It's pretty good. Operating income, more than 50%. There's the operating leverage that we talked about. Earnings from continued operations trending up pretty strongly. That looks pretty good. They've been issuing shares all along the way. Their income statement looks really good. Look at the debt. The debt has ballooned from 19 billion to 40 billion in that time frame, and then we're going to issue another 8 to 11 billion dollars of debt. So, and again, how much cash do we have? 140 million. Yeah, I mean, we don't know what these other current assets they have here. About 7 billion of current assets versus 40 billion of debt. 15 billion of tangible book value, which 77 billion of property, plant, and equipment. So they've got lots of hard assets. That's good. Regulatory assets, not sure what that is. Current liabilities 8 billion versus 7 billion of current assets. So look, their balance sheet doesn't look that bad. It doesn't look particularly good either. In fact, it's like when you have such a safe underlying um, stream of cash flow, think about like the government, right? Like the government, there's all this talk about, oh, the government, the federal government of the United States keeps issuing debt. Well, it's underpinned by the U.S. taxpayer, right? And increasingly tariffs and all these other revenue streams, but mostly U.S. taxpayers, individuals and businesses, small businesses, large businesses, and whatnot. And so that's such a strong cash generative vehicle that when you just keep kicking the can down the road by issuing more and more debt, again, I'm not condoning that, but I also understand it too. Like equity is always more expensive than debt. So while I am encouraged by the fact that they are going to be able to get away with, or they say they're going to be able to, and I don't disbelieve them, that they're going to be able to get away with raising all this debt and hardly any equity. I think we also need to take into account that their balance sheet, their balance sheet is not. They've been adding that kind of debt every 3 years already. So what? I'm just a little perplexed, I guess. I'm just a little perplexed at what have they been investing in exactly. They got to bring all this stuff up to a more safe standard through infrastructure. What is the Where is the $20 billion come from and gone? Right? We know where it's come from. It's come from the debt, and I don't have the QSIPs of the debt pulled up in front of me. Um, and frankly, I need a better way to show that to you on camera because uh, normally I'd go on to Interactive Brokers and look at that. I don't want to mess with all that. But if I'm not mistaken, a lot of the debt that they've issued um, over the last several quarters, it's not cheap debt. Like it's um, 6, 7, 8% coupon rates. So it's not junk credit, but yeah, I mean, it's not. This kind of growth is necessary for them to be able to just continue kicking the can down the road. So I'm I'm not discouraged, but I'm not encouraged by their balance sheet. They are heavily indebted, and that trend will only get worse here. It doesn't mean that they're going to go bankrupt or that they're not going to be able to service it. I just I understand where the market's coming from. I guess is what I'm saying. So now I want to take a look at this. The U.S. Department of Justice filed 2 lawsuits against the company, accusing the utility company of sparking the Eaton and Fairview wildfires. Said it's seeking $77 million in damages, repeated negligence, lawsuit, power infrastructure. Okay, look, let's be honest. $77 million is kind of a slap on the wrist compared to some of these other numbers. I don't see any news here about bonding, what they agreed to pay. Yeah, I mean, look, this company and PG&E are holding on to the shares of these companies is not for the weak, okay? Because it's like you just scroll through this feed and it's just wildfire, 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 wildfire. They outlined here $925 million rebuilding plan to rebuild Altadena and Malibu areas, including the replacement of more than 150 miles of damaged electrical power lines with underground lines. Decommissioned line could have caused Eaton fire. The line has no connection to the power grid. It's concerned that it may have started the fire. For the move station, billions of dollars to tap a $21 billion fund established by the state to help utilities manage liability costs, and to do so without reimbursement requirements. Okay, well there you go. So the state has a $21 billion fund help utilities manage these liabilities, but they have to basically prove that they weren't negligent. So look, here's the deal. It's if you're one of those investors that just loves to buy like a screaming dirt cheap deal when fear is high, uncertainty's high, and all that. This looks like a decent bet because it's at a really good valuation. I mean, by all traditional metrics, the valuation just screams here, right? Just screams. And even this, again, they said that they're paying out. They target 45 to 55% payout, and their yield is 6%. I mean, that's pretty strong. I wouldn't. After looking at everything, I'm really not convinced that they'll need to cut the dividend or strongly dilute shareholders in order to do this. So I think from that regard, your valuation is very strong, very very strong. In fact, let's look at it on the yield. Yeah, I mean it's the equity is trading at a 10-year, pretty much a 10-year high or 10-year low valuation on a yield basis, um, and the dividend has grown quite swimmingly. You see here, equity holders kind of took a bath between 2000 and 2004. So there was that. The dividend growth very slow in the Great Recession. Um, but this company's been a powerhouse, no pun intended. If you're just looking to get dirt cheap value uh, at a good price and you want to scrape a dividend, um, I think this looks like a pretty decent thing. But then you got to think about what it is that you own. You own a new headache about a wildfire. It seems every year, right? If you're okay with that, um, fine. They were already dealing with wildfires before all of this crap with the LA fire happened, and then it's just another huge liability that they have. So, how many more of those are there out there, right? Maybe they'll be okay. Seems like they might be okay based on what's going on here, but does this ever end? Is there any end to the suck machine that is owning this stock? Again, nothing negative about the company or anything like that. It's just more this vortex of suck that it's essentially perpetually under. And if you're okay with that, you're okay with that. Um, so I think from that lens, yeah, if you're going to accumulate shares in the equity, you now would be a decent time. Uh, I kind of regret not pulling the trigger on the debt though, because you don't really have those same worries when you're holding the debt. You're more senior to the equity, and you're definitely going to scrape that coupon. So with the whole purpose of owning the equity in anything is to experience the upside that comes over time, the increase in the dividends, um, and they might have decent earnings per share growth, but buyer beware, right? They've already signaled and basically stated that they do plan to continue diluting shareholders to be able to pay for these liabilities. So that's why I would think that their earnings per share is going to grow slower than their underlying base rate growth, the opposite of operating leverage. So for that standpoint alone, um, I'm pretty lukewarm on this one. I think it looks like a decent holding to maybe make a small bet on here. Um, but there's a reason that it hasn't recovered, and I really don't see there being some catalyst here anytime soon that like shoots the stock up by 60% back to $80. It'll probably get there, but it'll be slow. So yeah, I think it is a value situation. I think it looks decent, but um, you know, I'm not super enthusiastic about it. But I grade it a very soft buy. I would say if it was not a utility business, I would think differently about it, just given all the risks. But that's just kind of the reality of investing in businesses like this is that a lot of their worst qualities are their best qualities, being the the monopolistic nature of their business is what creates a lot of the complacency in their power lines and the maintenance and all that. They don't have to compete with another entity, really, um, and it's just a classic example of why monopoly is not good. And I find it very ironic that the power companies in California are so monopolistic, given the political environment of California, versus we used to live in Texas, and there are a million power companies that serve that area, serve the areas across the state. So, anyways, I'm not making a political statement. I have thought that the companies in California, the utility companies in California, like they have a very entrenched position, very entrenched position, and their pricing power is real. Um, and as long as the demographics of California remain modestly positive over time, that these companies will continue to generate decent uh, underlying economic returns. But I do think that the shareholder returns underperform the economic returns of the business over time because of all the risk and everything. So if you are going to purchase shares in the company, just I guess be okay with underperforming over time and know what you're doing. Know that what you're investing in is basically an income stream, and it appears safe for now, but you know it, the unpredictability of the wildfire risk does kind of cloud my enthusiasm a bit. Um, However, the bond holdings or the bond issues are a little bit more attractive in my opinion. So brief technical analysis before we conclude. So you see here we're in this long channel here, bouncing roughly from the area we're at now, a little bit higher, like 57 ish. We're bouncing from the 57s all the way down to what is that, 47 or so. And I think it goes without saying that we are at the high end of this range. So, from a technical perspective, the chart is interesting. We can continue to ride this trend line up, and then I expect to face some resistance along this line here. If we fail, we bounce back, and this is kind of an explosive decision point here. But if we break down through this trend, we could end up all the way in the 40s. But if we break above here with momentum, with volume, if we break above here, um, perhaps we just keep going. Again, the likelihood of that occurring, I would think is very low, given the fact that there's not everything seems to be settling or have settled. Again, I didn't really dive deep into that. I think that would really underpin a much more sophisticated and wholesome technical analysis. When does the dust settle on everything wildfire, right? Resolution of legacy wildfires in your firing final stage. Cost recovery applications for fires that happened years ago, now filed. See how long this takes. It's just it's just never ending. You can probably tell the way I emotionally feel about this, right? Not great. Maybe the resolution of those things are not as material to the stock price as imagined. It's merely a case of the stock bottomed and it topped here, and we have yet to break out of that. If the price breaks above uh, this with volume, that might be fairly bullish in the short term. Um, but if it breaks below here, if it breaks below here, it's quite the opposite. I would not be surprised if it dipped all the way down, dipped all the way down. Hopefully, what I'm saying is making sense in terms of the catalyst. The catalyst here was just a very visible wildfire, and this is just another day at the office for this company. It seems like so. Maybe that's an argument for why it's a good deal here. That it's just this happens to them all the time. but it seems like it takes a long time for the dust to settle on fires, 7 to 8 years on these other fires. So I guess the thesis summed up is, yeah, if you're okay with the fact that the company will continue to issue debt and equity as well in order to pay for these liabilities, and there really isn't much of a reason to believe that that trend will reverse in the opposite direction. Um, Hopefully it does. They say, hey, we're going to, you know, beef up all of our lines and make sure this doesn't happen. Well, okay, would love to see that, right? So if you're okay with collecting a 5 to 6% yield with the volatility that comes from the wildfire risk, then it might be a good buy for you. I'm not sure that uh, yield alone, that pure yield alone, is much to get excited about. However, I will say, but the fact that they've got a 6% yield on a low payout ratio, I guess, does mean that their cash flow yield, the free cash flow yield, is substantially elevated. It's about the same as their payout ratio, given all of their CapEx. Operating earnings yield is insane. So a lot to like, but a lot to not like too. So that'll conclude our video for today. Hopefully you found this interesting. I definitely bounced around a lot. Um, Again, that's kind of the style when I have a viewer suggested thing. There's a lot that I don't cover because I really have limited prior knowledge about the ticker or the business, and I just kind of think through it in real time on camera. So hopefully you found this interesting. Again, shout out to JM Action. Or J Maxon, or however I say that. Shout out to you. Thank you for engaging with my content, for giving me suggestions to take a look at. I have another one to look at here, LYB. I see the value angle on this. It's definitely at a value price. And I see the appeal. But for some reason, I can't get super excited about it. I feel like it's like one of those things that I should be excited about, but I'm not, and it's really hard to explain other than that. It's just the problems that it has do not seem very temporary, I guess is the best way to put it. But that's okay. Again, maybe it just continues to be at a value price, and you get access to very strong yields over time, continued accumulation of shares. So, anyways, I'll quit talking. It's been fun. Thank you for watching. If you found this interesting, please consider liking the video, subscribing to the channel, commenting below. Thank you.